Hello everyone, my name is Vishal Tekshanani. I'm a senior editor here at Livewire Markets, and it is my great pleasure to reveal to you the results of the very first Livewire Long-Term Investing Report. This report is a project that looks at what really built wealth for Australians over the past 20 years. So together with my colleague Kerry Sun, who's our in-house data wizard and does much of the content of Market Index and who you may be familiar with, and property research company Cotality, we have crunched the returns of the major asset classes which have shaped Australian investors' portfolios for decades. Specifically, we looked at the total returns for Australian and US shares, residential investment properties, A-REITs, bonds, gold, and cash. The idea behind this report is simple. It is to get you to open your eyes to what's been a really strong investment. The results are going to surprise you, and while past performance isn't a guarantee of future returns, it's really important to take stock of where we are in markets. What does the future hold as far as, where the world is heading from a geopolitical and economic and a monetary policy sense, and how to optimize your strategic asset allocation to make sure that you're capturing good risk-adjusted returns for the future. And just for your benefit, I have provided a link to an article associated with this video in the description. Please do go to that article. It will tell you the methodology we used. You'll have the full analysis, and you will have access to a very beautiful free chart pack that we have produced to go with this report. It's got beautiful visuals. I strongly encourage you to download it to follow along with what I'm saying, and also to print out and put up on your wall. Now let's cut to the chase, my friends. Let's look at the performance of these asset classes from worst to best. Okay, in last place, and this is no surprise, it is cash. Cash, as they say, is king in the short term. When you need the money, when you need the liquidity, when there's a buying opportunity in markets, cash really is king. But over the long term, the other saying is truer, which is cash is trash. Cash has delivered a 20-year annualized return of just 3.03%. And when you compare that to inflation, which averaged nearly the same amount, you've essentially been running on a treadmill. Importantly, if you look at the chart pack that we provided you, it will show you that over most periods, inflation was actually higher than what cash delivered in terms of returns, meaning that the real value of your money went backwards. Now, really, the reason for cash's performance, of course, number one, it is the most defensive investment. It is going to naturally provide the lowest returns. But what really drove those low returns over the study period was the period of ultra low rates, particularly across the 2010s, when central banks cut rates to pretty much 0% following the global financial crisis to reinvigorate economic growth. So putting money in the bank really hasn't paid off over the long term. So coming in at number 6 is Australian fixed interest. So this is the benchmark that measures the performance of government and corporate bonds in Australia, and it delivered 4.24% per year over the last 20 years. Now, for much of the past 2 decades, fixed income has actually done its job. It delivered stable returns, it delivered predictable cash flows. But then the role of fixed income came into question during 2022, when we had the most aggressive rate hiking cycle in modern history by central banks in an effort to control inflation. Okay, coming in at number 5 are Australian real estate investment trusts, known as A-REITs, also known as listed property securities, which delivered a 20-year annualized return of just 0.05%. Now, honestly, this is not the most exciting given the level of volatility that this asset class has subjected investors to. If you're a long-time A-REIT investor, you would have noticed the 2 horror years that this asset class had. In 2008, listed property securities lost more than 50% of their value because they were leveraged up to the hilt in the lead up to the global financial crisis, which caused a credit crunch and froze up credit markets. So A-REITs lost a lot of money during that year. And then in 2020, of course, listed property had a stroke of bad luck. The business model of commercial properties, namely office towers and shopping centers, came into question because no one needed to go into work anymore. You weren't allowed to go to the shopping malls. The viability of these businesses came into question, and asset prices within the sector really sold off. However, it is recovering, but certainly the returns of A-REITs, they have been in the middle of the pack. Okay, my friends, we're getting to the juicy part of things, and I'm going to do number 4 and 3. Number 3, of course, took out bronze place at once. Now, as part of a poll that we ran before we published this report, we asked our audience if you thought Australian equities beat residential investment properties for returns. More than 70% of you thought that a simple ASX 200 fund outperformed the typical resi investment property. Unfortunately, my friends, that is incorrect. Coming in at number 4 are Australian shares with an annual return of 7.55% over the past 20 financial years, compared to nearly 10% for your typical Australian resi investment property. Both figures assume dividends and rents are invested back into the assets. So we've assumed that cash flows have been reinvested back into those assets to make it an apples to apples comparison. And in our study, the ASX 200 unfortunately delivered very much middle of the pack returns over the time period that we looked at. And that's largely because of the skew of the ASX 200 index towards banks, resources, supermarkets, Telstra, which of course provide fantastic dividends, but really don't have that excitement as far as a growth story goes. In comparison, residential investment property rode that period of ultra low interest rates, as well as the national obsession that we have with owning a house in this country to deliver very strong returns. Next week, I'll be speaking to Tim Lawless, who's the head of research at Cotality Australia. Please make sure you subscribe to our channel. That's going to be an awesome interview because Tim is going to walk us through which cities within the investment property universe perform the best. We're going to be talking about the outlook for the next 20 years for you property investors, and he's also going to give his number 1 pick to put your money in as far as investment properties go. So make sure to subscribe to our channel so you don't miss out on the notification for that video. Taking silver place in our study are US shares, which delivered a very attractive return of 10.53% over the past 20 financial years. When we looked at the performance of US shares, we basically looked at the S&P 500 in US dollar terms with dividends reinvested. So the returns were in US dollar terms. Now, if you were an Australian investor and you bought the S&P 500 on an unhedged basis, your returns are actually closer to 15% because of the downtrend in the Australian dollar, from above parity in around the 2010s to 65 to 70 cents over the last year. So there's been a currency tailwind for you there over the long term if you'd invested in the US market. And what this has really come down to is the reinvention of America during the 2010s, when the US recovered from the global financial crisis. You had ultra low rates, which gave rise to the Silicon Valley giants like your Metas and Amazons of the world, which were able to raise huge amounts of cheap capital to create these businesses which have completely changed the world. So if you think about that and where we're at now with artificial intelligence, and the other key themes of cloud computing, digital media, productivity, the US with its technology sector, according to asset allocators, still remains a core part of portfolios for diversified investors today. Okay, my friends, it's crunch time. If residential investment properties got bronze in our study and US shares got silver, well then what the heck got gold? Turns out it's in the name. Gold, my friends, got gold. Gold delivered an outstanding return of nearly 11% per year in our study, making it the top performing asset class. And those are annualized returns over the past 20 years. And again, they are in US dollar terms. So if you invested in a gold ETF, which typically is unhedged, you would have gotten the benefit of the falling Australian dollar, making your returns closer to that 15 to 16% mark. Now, without going into the detail, the last 20 years, it has been the perfect storm for gold. When you think about the twists and turns in the global economy, we've had a near depression scenario out of the global financial crisis in that late 2000s period to an era of ultra low interest rates and enormous amounts of money printing by central banks in the 2010s. We then had this uncertainty with COVID in 2020, and then since then we've had nothing but geopolitical tensions, volatility, and more recently Trump tariffs and Donald Trump himself injecting enormous amounts of uncertainty into the global economy and really making people question the value of fiat currencies. And gold has stood the test of time keeping its place or its reputation as a store of value for investors. So there you have it, my friends. Gold is number one in this study, and this certainly was a huge surprise to me as well. Now, just a quick recap. Gold gets number one at 10.74% per annum. Silver goes to US shares at 10.53% per annum, and bronze goes to resi investment property at nearly 10% per year. And again, stay tuned for next week because I'll be talking to Tim Lawless from Cotality about where the best returns were for Australian resi properties over the past 20 years. You don't want to miss that interview. Please do drop a comment. Were you surprised with this report? Are you going to change your strategic asset allocation? We would love to know. Do drop a comment. Again, head to the description and please download that beautiful chart pack from the article on Livewire that we've produced as part of this report. I hope you enjoyed this content. My name is Vishal Tekshanani. Have a great day.